Hey everyone, it's Mike from Orderflows, and this is a re-recording of the Orderflows Trader weekly group training. This was from this past week, the Monday, August 13th session of 2018. This is officially the second session. Now I'm re-recording this because I'm going to post it up on YouTube. The reason it is because I realize now I can't re-record these and throw them up into the members area. So, this video is really meant for users of my software, or people that are interested in order flow. It's not meant to be just a general education. It is specific to my software and for users, specifically users of my software. But before I jump in, just a brief disclaimer: this presentation is for educational and informational purposes only. It should not be considered a solicitation to buy or sell a futures contract or make any other type of investment decision. Futures trading contains substantial risk and is not for every investor. An investor could potentially lose all or more than the initial investment. Risk capital is money that could be lost without jeopardizing one's financial security or lifestyle. Only risk capital should be used for trading, and only those with sufficient risk capital should consider trading. Past performance is not necessarily indicative of future results. Alright, so, when I started the presentation last week, one of the things that I wanted to point out to people is, if you're not on the latest version of NinjaTrader, and which version should you be on? You should be on NinjaTrader 8.0.15.1. So basically version 15. And how do you find what version you are on? Just give me a second here and I'll pull it up for you. Let me just get my NinjaTrader screen up here. Okay, this is the bonds. Just bear with me here. Okay, so NinjaTrader, when you load up NinjaTrader, when you start it, you have this thing. It's called the NinjaTrader control panel. Go to help, go to about, and you'll see it here, version 8.0.15.1, 64-bit. This is the version 8, most recent version. And how do you find that out? Is you go to Google. Oh, sorry, once you find that out, how do you upgrade, rather? You go to Google. It's really simple. Type in NinjaTrader 8 download. Click on this thing. It's ninjatrader.com/platform direct. Enter your license key. I think mine just comes up in here automatically. Hit submit. It'll process it, and it'll tell you, once you get past it, because it wants to make sure you have a NinjaTrader license key, and you just choose which version you're on, 8, 7, or 8. If you're still on 7, I know people are still using 7, and that's fine. You can still use 7 with the NinjaTrader 7 versions of my software, but you should really consider being on NinjaTrader 8. And I know there's a lot of people that haven't yet, they're already on NinjaTrader 8, but they're not keeping up with the upgrades or the updates that NinjaTrader puts out. I know people that are on NinjaTrader version 5, NinjaTrader 8 version 5. Me, before I jumped to NinjaTrader version 8, NinjaTrader 8 version 15, I was on version 12 from earlier this year. So, make sure you're on NinjaTrader 8 version 15. That's the version that we're using with the software, and it'll still work on the earlier versions, but all the new developments that we're doing with the software are really optimized for NinjaTrader 8 version 15. And our new licensing thing that we're releasing now works with NinjaTrader 8 version 15. So what was this past Monday's conversation about was the main conversation revolved around questions about what chart types do I use. Do I use range charts? Do I use minute-based charts? Do I use Renko charts, etc.? And I use mainly range-based charts and minute-based charts, and I'll get into that in a minute. But there's two types of, basically two durations on range charts that I use. I use 4 range and I use 8 range. And one of the reasons why there's a 4 range and there's an 8 range is because, on markets that aren't as volatile, markets that don't move around so much, I use a 4 range chart. Markets that have more volatility, I use an 8 range chart. So things like equities, I use an 8 range chart. Markets like bonds, I use a 4 range chart. So bonds, 5 years, 10 years, I use a 4 range chart. On markets like S&Ps, mini Dow, NASDAQ, crude oil, euro currencies, I use 8 range charts. Now, NASDAQ is a bit more volatile than, a lot of these other contracts. I do break it out actually to a 10 range chart. And why do I keep a 4 range and an 8 range chart for E-minis? Is because, in the past, before Trump got elected, you used to have very boring days. You'd have days where it's a 10 range session, the entire session. And if you're trading a 8 range or a 10 range chart in E-minis, S&Ps, you're not going to get very many trading opportunities. That's why I look also at E-minis on a 4 range chart. But, crude oil, mini Dow, Euro currency, 8 range chart all the way. I don't really like to look at them on, I had one guy looking at a 3 range chart on crude oil, and, he kept telling, saying he's struggling reading the order flow. Well, of course you are. The market's moving too fast for you. And, you got to choose a chart type that you can manage. And do I look at minute-based charts? Yes, I do. Actually, I keep usually like a 1 minute, sometimes a 5 minute chart. Earlier I was looking at 5 minutes in the S&Ps here. So this is a 5 minute, but usually I keep it on a 1 minute chart. And I'm not necessarily a big fan of minute-based charts in the sense that, I like to see how price moves over, or how charts are formed as price moves rather than how charts are made as time moves. Like here you have, well, this is a 5 minute chart. So, okay, it's 12:40. I got to start a new bar. Okay, it's 12:45. I got to start a new bar. I'm much more interested in seeing how price moves, up or down as you start forming, new bars. I mean, when you look at a range-based chart, a new bar is going to be formed when you cover a certain price range. On a 4 range chart, it's going to be 5 prices. On an 8 range chart, it's going to be 9 price levels, because you have to break out of that extra level to form a new bar. So I find it much more, I'll say cleaner. I don't know what the term is, but I find it more effective in reading, range-based charts than necessarily than reading minute-based charts. Now, again, don't get me wrong. That doesn't mean that you have to throw out your minute-based charts. Again, I also look at minute-based charts, and oddly enough, for what it's worth, I do find that imbalances actually tend to work slightly better, I think, in E-minis on minute-based charts than on range-based charts. Now, again, there's nothing scientific behind that. That's just been my own observation. Again, don't say, well, Mike says this is what he says, so it's got to be true. No, of course not. Do your own research. I said in my own analysis, I said mostly I look at range-based charts, and I think a higher percentage of stacked imbalances don't work on range-based charts relative to minute-based charts. And again, one of the differences when you're looking at, say, a minute-based chart as opposed to a range-based chart, you're going to get these times of the day where the market is just quiet, right? You're in this period where there's not a lot going on, and you're just trading basically the bid and the offer. And, if you're trying to read order flow and there's no flow coming into the market, you're going to fall, you're going to get tired, you're going to get bored, and you're going to stop watching the market, and then the market's going to start to move, and you're going to miss out on it. Trading is boring, and I'm sure that's not what a lot of people like to hear. They think that trading is exciting, but honestly, it's a very boring thing to sit through when the market's not moving. It's literally just like here's you're seeing it's just basically trading the bid and the offer, the bid and the offer, the bid and the offer. For how many minutes? And that's why I prefer range-based charts, is because I don't fall into this lull or this hypnotized by the market in that it's not moving. If I'm looking at a range-based chart, going back, because where is it here? Okay, yeah, you're just forming little bars. I could see some support is being formed in here on a market that's just trading sideways. We haven't come up and hit these other levels up here. Support that had failed has become obviously a resistance, but I know I got resistance here. So, support here. So I got support here and resistance here, and we're just trading back and forth. Okay. I could see that a lot clearer than if I'm looking on on a minute-based chart. There's just not really much going on, and hard to make heads or tails of it. So that's why I prefer, a range-based chart. Like this is a mini Dow, this is an 8 range chart, as opposed to, you know, a minute based chart. You know, this is my Bund chart, it's a 4 range chart. And, you know, whether it's an 8 range chart or whether it's a 4 range chart, I'm looking at the exact same things. Okay, I'm looking for areas of price support, price rejection, trap traders, you know, divergence, everything that I look on a 4 range chart. I'm also looking at an 8 range chart. And basically it comes down to, what do you want to call it? The basic volatility of the market. You know, markets that aren't as volatile, I use a 4 range chart. Markets that then have wider ranges, more volatility, I use an 8 range chart. Okay, so that answers that question. Now, another question that I get is, how many trade setups do I got? You know, it's like, do I have a lot or a few? And, you know, I have like a handful that I call, you know, my bread and butter trades. And for anyone that's been watching my videos or have my software and have been listening to me for a while, you know, for years rather. I mean, there have been, you know, some that have been following me for years, and they know that I talk about this trade, the ratio, this blue number, and the divergence. You know, this is one of my bread and butter trades that I look for on a daily basis in every market. What is a divergence? Well, it's a new or equal low with positive delta, or a new or equal high with negative delta, and price action, confirming price action. You know, it's not just a new equal low and positive delta or a new equal high and negative delta. I need price action to also confirm it. Now, there's some people out there that have a delta divergence indicator and it just reads the delta and the new high or the new low. But, you know, if I'm going to put in a new high or new low, I want to make sure that price action is confirming it, because if you're making a new low with positive delta, okay, well, you can still make new lows with positive delta, because what would be happening is, you know, there's bids in there supporting the market that sellers are aggressively selling it. And oftentimes you see, if you have some bids in there, there's, you know, people see, you know, people that trade a dome, right? Say the market's coming down, hits this low at 163.22, and there's 1,000 lots on the bid. All these little dome guys are reading, oh my gosh, there's 1,000 lots on the bid. They start lifting the offer. So you're going to see positive deltas, you know, because they're coming in. They're thinking they're jumping front running that 1,000 lots on the bid. That's just there as paper supporting the market. So you do get positive deltas, and the market just keeps going lower, 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 because you still have aggressive sellers in there, and they sort of tricked out the guys that are trying to read the dome and jump in front of a paper order. But anyway, so my divergence indicator reads the price action as well, in addition to the delta. Okay, so, you know, but the point is, if you have a trading method, right, you have to have more than one, okay? Because if you have one, generally it works good in one type of market, okay? It's going to work good in a trending market, or it may work good in a consolidating market. But if it's a system that works good in a trending market, it's going to work most often miserably in a consolidating market. Or if you have a method that's great for trading in a range when the market's trending, you're going to get screwed big time, right? You're going to keep taking loss, 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 and constantly lose money. So, you know, that's why I say, you know, you got to have more than one trade setup that you're looking for. Now, you know, just really quick, another one, if I can find it here really quick. Where was it? I just saw it. This is the Bunds. Is, you know, the divergence and a prominent point of control. You know, for me, these are great selling opportunities. This one, yeah, did it sell off? Yeah, a little bit. Here, I think there was a much better one, clearer. I don't want you to think I'm cherry picking, but you know, there's one here. You got a nice little sell off here. Another one. This one failed. Here's a ratio and divergence. Right up here, this is over here is just a divergence with no ratio. So, you know, these are some of the setups that I have. These are to find market reversals. Now, I have setups that I like to look for as the market is trending as well. So, you know, when the market's trending, I like to have setups that confirm, you know, if I got short up here, right, as the market starts coming down, I like to see confirmation in the order flow if I'm already short. If I'm not short, there's certain setups in the order flow that I'm still looking for. Okay, so as the market starts moving, you know, when you form a high or you form a low and then you start reversing, and, you know, everyone says the trend is your friend, right? So now you got to have a method for taking advantage of that trend once it's underway, rather than just try and fade it, say, oh, I got to try and buy it here. Okay. Like if I was, here's a market that's trending higher, you got a divergence by itself, you got a divergence by itself. This time you got a divergence in prominent point of control. This one failed, right? But what happened is, what's assigned to me that's going to fail is you have a bullish ratio right here. Okay. So, I would take this short. This is a short I would take every day, anytime I see it. But I know that I'm probably going to get, I should get out of this trade because it's a high probability I'm going to get stopped out when it follows up with a bullish ratio. If I have a bearish trade set up here, when the order flow is telling me, hey, we got some signs of price rejection, in the sense that it's not a low, but rather, the market is moving higher, you're making new highs. Sellers aren't really interested in selling it off. The supply is there, but how to describe, I'm trying to think of the way to describe it. It's not coming out of my mouth properly, but what's happening is, the selling is weak is the point I'm trying to make. I see in here there's signs of price rejection, and it's weaker in the sense of relative to the buying that's going on here. So I know that there's more to this move higher. And again, when I see failed divergences sort of grouped together, I also know that we're sort of in a trend. The market's going to start to trend. So again, you got a failed divergence here, a failed divergence, and a failed divergence with the prominent point of control. Okay. Then I see something in the order flow here is a bullish sign, and the market starts rallying back up. And of course, we got still positive deltas up here. Now this high up here was interesting because, again, it's divergence and a ratio. But if you're watching the delta, you can see in here how the delta is changing. It's very strong coming up to this high. You hit the high and then it's very small. It's negative. And maybe you're not convinced. Maybe, you know what, Mike, you're an idiot. You don't understand order flow. I think we're still going higher. Well, if you read the order flow here, okay, read the delta rather, you see it's minus 700. Okay, Mike, you don't know what you're talking about. You got your head up your ass. Well, by this time, you got a bearish ratio indicating, there's less buying going on up in here. People that take it back higher. How's the market going to go higher? Is you need buying to come in, but you got a bearish ratio, which indicates that buying is drying up already. And here, negative delta. And what happens is the market, boom, 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 starts selling off till you get down in here where you got a prominent point of control, an area of support, and the market starts to bounce here and start working its way back up again. But, this was a great setup on a couple of different things, on delta, on your ratio, on your divergence. This is what I talk about, not trying to pick highs or lows, but rather let the market tell you what's going on. This trade here would have been a loss. This is a trade that, again, I espouse. I say you got to take these trades, but this one was a losing trade. Okay, fine. Then you wait for the next trade. Okay, and then here I said, if you just had a method, right? If your method was just, well, I'm just going to trade divergences by itself. Okay, well, let's see, you got a divergence and a ratio here. This one worked. Here's a divergence by itself. This one failed. I'm not going to say it worked. I'm not going to say, yeah, you would have sold right up here and covered it down here. No, that's a fail. This one's a fail. This one worked out. But, when you can refine it a bit with, ratios and divergence, or divergence and prominent point of controls, you sort of eliminate trade like this one. If you can eliminate, imagine if in your trading you can eliminate 10% of your losing trades. What would that mean to you and your bottom line at the end of the year? All right, it could be a huge difference. Now, a lot of people think that, well, when they learn order flow, they got to disregard everything they've ever learned about trading. No, what I'm saying is, take the pieces of order flow, what you can add to your existing form of trading. I've worked with a lot of traders that are already successful in their trading, but they come to me, they say, hey, Mike, I want to know if I can add order flow to my trading. Can it help me sort of turn that corner or eliminate borderline trades? We all take those trades that look good on paper, like textbook examples, and as soon as you take it, it fails on you. And people say, I need to refine, some of my entries or my exits, or, if I could just get an extra couple ticks out of each trade, or, you can imagine you just get one tick out of each trade. Say you take, 2 trades a day, but you're able to get one extra tick out of it. What would that mean to you at the end of the year? And, so I get traders that already have their method of finding support and resistance levels. They use pivot levels, or they got their own method I won't get into. That's not important. But they want to know, curious, how does price react when we get to those levels? Are there signs of price rejection or price support or absorption? And that's where understanding order flow is going to come in and and help you out as a trader. If people have a method of saying, hey, we get this pullback a certain amount, but if I see there's a sign in here with with the ratio of price rejection or price support, that's going to help them. And a lot of people have taken my tools and added it onto their method of trading and found that it's improved their trading. But again, it's not, will it work for everybody? Maybe, maybe not. It depends on how you're trading. Now, I've got a couple indicators. I got like the price rejector, I've got the delta scalper, and people always ask, what's the difference? Do I need them both? Well, I say, how are you trading? I don't say you got to add every single tool that I create and use every single tool at all times. Price rejector reads the order flow looking for signs of price rejection. Delta scalper reads the order flow and analyzes the delta in there. So, like here, this is the mini Dow, this is the delta scalper. So here you got a delta scalper sell. It's reading the delta and price action. Here you got a delta scalper buy. This one just sort of went sideways. Then you got another delta scalper sell here. And, it's sold off a little bit, retraced back up and sold off. But it's different than, say, a tool like the price rejector, which is looking for signs of price rejection in the order flow. Here, price rejection, we sell off in an area where prices are being rejected to an area, a lower level where prices are being rejected on the order flow here, and we rally back up to another area of price rejection up in here, and when we sell off again. Now, so it reads different things in the order flow, right? And one concentrates on delta, the other one concentrates on the order flow. There's no one right way to approach the market. If there was, everyone would do it and the markets wouldn't move. And that's what makes the markets so dynamic, is everyone's got a different way, a different viewpoint of the market. Some people like to look at moving averages, some like to look at MACD and everything. And then, at the end of the day, they'll say, well, it doesn't work. Or they'll say markets are random. Are markets random? I don't think so. I'm not a big believer in that. If, people trade the market, so there's a human element involved in the market that makes it non-random. You'll sometimes see a lot of stuff there, it just doesn't make sense, where oh my gosh, I see all these numbers, I can't make heads or tails of it, and you'll think it's random. But if you can break it down and look for certain things, you can see, okay, well, I got signs of price rejection. That's why the market often turns at these levels. And again, it's not something that I don't think the markets are random. I've never been a big believer in the random walk theory. The people that come up with these ideas have most likely never really been involved in the markets and don't understand the human emotion element that goes behind it. And I don't want to expound on that any further, but I don't believe the markets are random 100% of the time. But if the markets were random, you wouldn't be able to read what people are doing in the markets. All right, so the other thing that I wanted to touch on, because I love my users because they're big appetite for understanding order flow. So a lot of them have everyone's software out there, and they tell me what's there are those out there that really love my software and are like my cheerleaders and really support me, and I appreciate it. I thank you guys for that. And so the ones that have all the other software as well, they realize mine is I don't want to say groundbreaking, but I've come out with a lot of ideas that have been adapted into other users' software. Now again, I didn't invent stacked imbalances that had been around for a long time, but I think I'm one of the few that have advanced order flow over the years. I used to use a different software for order flow, and I started writing my book on trading order flow, and I wanted to use the charts of the order flow software that I was using. And so I talked to the owner of the software company, and he's like, yeah, you can, but my lawyers, you gotta sit down with my lawyer and sign all these papers and do all this. I was like, yeah, that's gonna be a headache. So I found my own programmer and created my own Orderflows Trader software. And at the same time, I said, hey, can you do this? Can you add ratios? Can you highlight single prints? Can you highlight the divergence with price action? He's like, yeah, you can do all that. So we sat down and I gave him a big list of things that I wanted to see, and one of them was the single prints. Okay, and if you've been using my software since 2015, you've been able to use these single prints, and there's nothing fancy about single prints. It's not some hidden thing in the market. It's just about reading the order flow, and if there's a single print that appears in the top of a bar or a red candle, it appears there, it'll highlight it to you. If it's a green bar, it'll highlight it to you on the bottom. And that was 2015 that I released that. And just recently, in the new version of OFA, Order Flow Analytics, version 1.6.1, what do they got? In 2018, 3 years later, welcome to the present. Single print exhaustion at bid or ask. At the highs will be marked on the ask price and lows will be marked on the bid price. How does it look? Well, oh my gosh, it's the box around the single print. And I got nothing against OFA. I don't know them personally or anything like that, but at least they have the decency to call it what it is. It's single print exhaustion. They're not coming up and try to call it some order flow single print algo trader thing, like what it's not. It's a sign. I've always referred to it as price rejection. They refer to it as price exhaustion. But again, I've had it in my software for years, and they just added it into their software over the last couple of weeks. But what it is why it's called the single print is because it's a single digit, right? People say, what is that single print thing? Well, it's a single print. That's a single print. And you do get single prints in the bars, like here you got 6, you got 0. That's something else. Really, what it's looking highlighted is at the end. And how do I use it? Is I look for it in moves. If it's occurring at a swing high or a swing low, or if it's just occurring in the middle of a move, it means something different to me. And I believe I've explained it already in some of the videos, other videos for my users. And basically what it's telling me is, why do I want to know what a single print is, and why do I call it a single print? Well, one, it's a single digit. If you're a basketball fan, you remember in the 90s the Chicago Bulls went 72-10. And afterwards, they're like, well, we wish we had one more win, so it'd be 73-9 and have that single print in the record books. The Golden State Warriors a few years ago did a single print for the whole season, but they lost the championship. So, a lot of people say, well, that single print doesn't matter because he still lost the championship. But in trading, it's all it is on the Orderflow Trader software. It's a single print at the top of the red bar, a single print at the bottom of a green bar, and some of these tools that I have is to alert me to what's going on in the market. It's not like, oh my gosh, I got a single print, automatically got to get short, or I got a single print, a green one, got to automatically get long. You can, but that's not how I use them. It's more to alert me, saying, hey, you got a single print here. What it means is, in this case, I don't look at it as price exhaustion. I look at it in terms of price rejection. We're starting to come off, rally back up a little bit. Traders are rejecting these prices. You don't have that buying that you had earlier. You only got 8 people, 8 contracts traded here. So, when the buying dries up, well, the market's not going to go higher if the buying is dried up. If the buying is dried up, the market's going to, the selling is going to be in control, not the buying, right? Because there's no more buyers. And the market's just going to naturally gravitate low. And I find it much more effective, actually, at swing highs or swing lows. Now, in the middle of a move, let me find a good example. Like here, okay, so the market is moving, it's moving. I got a single print right here. How do I look at it? Is, okay, we're moving up. Sellers, people that are trading against this, against the buying, the aggressive buying that's going on, the aggressive sellers are weak. I see a single print here. It's telling me that there's, not a lot of selling at this level, that the buying is more, in the sense that the market is already moving. It's moving pretty quick, that the counter trade is very light here, 6 lots there. And I know guys that have actually taken the single print concept when I've introduced it to them, and I'm not going to get into it, but they've really built a trading plan around it, and they're looking for areas of retest of those single prints. That if you're really interested in the markets, that's something you can investigate further. But as a starting point, people always ask, what's a good starting point for me in, they like to do their own research and build their own trading plans. I say, well, look for single prints, look for certain type of imbalance, or, look for divergence and points of controls. There's so many different starting points. I know hedge funds are adapting more and more tools of order flow, and they're actually using the different things in order flow. They're using single prints, they're using imbalances, they're using divergence, and for them, it's just a data point. They're analyzing all the different factors around it. So, who knows where order flow is going to be in 5 years? Hopefully it should still be effective, but there's advancements that are going on well beyond what you're looking at right now. And that's why I said, these people that have developed an order flow chart 5 years ago that haven't made any changes to it. My gosh, and what's the point of creating something and not trying to make it better over time? That's why when we released the new Orderflows 2.0, we've made slightly more changes, additions to the tools, so traders can take that same information and find an edge over other traders that aren't using that those tools to analyze and look at the market. So anyway, guys, I'll end on that note. And again, this video is really meant for users of my software. It's but it's available. I posted it on YouTube so everyone can watch it, but I'm just not able to record it and throw it up into the members area. So again, if you're using my software, you want to join us on our weekly live training programs, you're more than welcome. I send out the invites on Monday mornings. So if it's Sunday and you haven't got an invite, don't say, oh, I haven't, you haven't sent me one. It's because it comes out on Monday, right? I don't want to send it out too early because they'll get lost in the emails, especially over the weekend. I send them out Monday, before lunchtime. So again, it's free for anybody that's bought my software that wants to come in and pay attention. If you think you're not on my list, just send me an email and I'll add you to the list. And it's nice because you could ask questions, or say you've made some changes to your computer. One of the problems with NinjaTrader is if you you upgrade Windows, sometimes you do get a new machine ID. Okay, and if you don't realize that, you think I cut off your access. And a couple people have sent me really nasty emails saying, why did I cut them off? And really what the reason was is they didn't realize that they did a Windows upgrade and NinjaTrader kicked off a new machine ID. Okay, and they just send me really derogatory emails, which whatever. I ain't got time for those people anyway. But be aware of that. Be aware of changes to your system, that sometimes you know that it's tied to a machine ID. You can get a new machine ID. If you think there's a problem with it, let me know. But again, that's why I do these weekly calls for users of the software, so that at least you have a time where I'm going to be every week, so you can reach out to me and not say, well, you're not replying to my emails. You know where I am. So come in and join the room. So thanks everyone. Have a great day, and I'll see you guys on Monday. Bye-bye.